recovery is certainly underway. We've all read the data and heck, we've even experienced it for ourselves. So there's no sense in doubting it, right? I mean, right? It's all good. Let's just enjoy the ride, right? Well, here's the deal. It sure feels and looks good, but I'm always looking ahead. Heck, I think that's why most of you even watch this show. So if I have my head down just looking at today, things look pretty good. I mean, properties are flying off the shelf, rates are still low, the Dow is soaring, but because of who I am, I can't help but lift my head and look forward down the unbeaten path. Now, let's take a break from all this craziness happening right now, open our minds, and just merely entertain some thoughts. Just for a minute. I'm not saying this is gonna happen, but I do think it's worth talking about. What if it's all hype? Now, here's an opposing view from a super smart man named Peter Schiff. Let's think this around the corner. What if government policies have channeled money into real estate in order to reinflate a bubble that has been collapsing for the last 5 years? Although the money is entering the market through slightly different paths than it did in 2005 and 2006, its effects on the housing and the broader economy are the same they were before the bubble burst. Schiff says when the inevitable happens, again, the ensuing damage will be eerily familiar. Okay, you're a bit of a downer, but we've said the same thing, so let's at least try to do the diligent thing and try to avoid our past mistakes and at least look into this. While the current market tastes and feels good, he says the question we should be asking ourselves is why are prices rising? Are those prices sustainable? And what are the costs to the broader economy? Let's look at his points. Schiff says the truth is that most buyers can't afford today's prices without the combination of government guarantees and artificially low rates. The Federal Reserve has been conducting an unprecedented experiment in economic manipulation by holding interest rates near zero and by actively buying more than $40 billion a month in mortgage-backed securities and $45 billion in treasury bonds. The Fed has engineered the lowest mortgage rates in generations. At the same time, the Fed control of the mortgage industry has become nearly complete, with government agencies Fannie Mae, Freddie Mac, and FHA buying or guaranteeing virtually all new mortgages. In addition, a variety of federal programs such as HAMP and HARP, well, those help keep underwater homeowners in homes that they couldn't afford otherwise. Now, taken all together, these programs create far more favorable terms for homeowners and home buyers than those that existed far before the crash. Okay, that's actually a really good point. We've actually said the same thing over and over again, so point for Schiff. Next, he points out that the big difference between then and now is that banks are more reluctant to extend home loans to people with bad credit. True, but that hasn't stopped the money from flowing into the real estate market. Ultra low interest rates also mean that fixed income investments that have long been the staple of hedge funds and private equity funds no longer deliver decent returns. To find yields in such an environment, many of these professional investment funds have scooped up single-family homes out of foreclosure and put them back into the real estate market as rentals in order to generate a decent return on equity. These buyers come to the market with war chests full of cash, which puts them in a position to avoid all of the credit obstacles that continue to plague individual buyers. Dang it, that's true too. You guys have seen this firsthand, and yeah, we've shot a show on it as well. Frick, another point for Schiff. He goes on to say that this trend has allowed a recovery in home sales while the national homeownership rate has dropped to 65%, the lowest rate since 1995. Interesting take, but no point for you. Not on that one. Next, the new homeownership class is not motivated to buy and hold the way mom and dad did. They are not looking for a place to live, raise a family, or even retire. They're simply looking for a decent return on equity relative to other investments. Many would happily put their money in higher yielding investments where landlord headaches don't exist. And if better deals beckon, or if risk continues to increase in the real estate market, the homes they bought will be dumped even faster. I hear what he's saying, but I'm not sure that I'm giving him a point on that one either. Now, if you guys are keeping score at home, you can give him a point if you want to. It would be quite an undertaking for Blackstone to offload all those properties that they just purchased, and the selling cost would be enormous. Staying with the hedge fund buyers though, bidding wars involving said hedge funds are forcing real buyers to pay more, often pricing them out of the market completely. Now that's true. Then as these properties hit the rental market, an absence of qualified tenants will depress the rents. I'm not so sure on that one. Lower rents will in turn put downward pressure on property values. Maybe so. Many rental houses will also sit vacant. Though hedge funds are cash buyers, most borrow large percentages of that cash to lever up their returns. However, when interest rates rise and rents fall, hedge funds will be forced to sell. I'll give you that, but I'm not convinced that they're going to sell newly purchased properties. But where will the real buyers come from? The current crop of renters can't afford to even buy with mortgage rates at historic lows. When rates rise, prices will have to plunge before real buyers could even qualify for mortgages. Yeah, well, that scenario just sucks, so I'm not sure I want to really believe that. The current combination of low rates and investor demand has succeeded in pushing up prices. Yeah, that's true, but that doesn't mean the market is healthy. Again, true, for the first quarter of 2013, the Federal Reserve reports a 10% delinquency rate for residential mortgages. Actually, I didn't know that. This is more than 6 times the rate in the first quarter of 2006. I really didn't know that. In contrast, credit card delinquency currently stands at only 2.65%. That's the lowest rate in decades and 31% lower than the rate in 2006. Now, whether it's by choice or simply by the ability to pay, Americans are clearly placing a lower priority on paying their mortgages. Yeah, but that's because people are still in short sales and foreclosures and they aren't paying their mortgages, but they continue to pay everything else. Nevertheless, here comes the aha moment. The wealth effect from rising home prices combined with similar influences on rising stock prices creates an aura of recovery. Aha, but can it last? Of course, rising asset prices are completely dependent on continued Fed support. Now, as we've seen time and time again, whenever the Fed even hints at tapering its massive QE program, the stock market sells off. The housing market is even more dependent on that support. So given all these risks, it is at least arguable that no private market for home loans would even exist without government intervention. The bubble that popped in 2008 consisted mainly of government guaranteed mortgages. This time around, the mortgages are not merely government guaranteed, but government owned. That's a very important difference right there. Now let me challenge your thinking here, and don't call me a Judas for saying this. A successful economy can't be built on housing. Rather, a successful real estate market must be the result of a healthy economy. There's a difference there. You can't put the cart before the horse. Interesting thoughts today. It's always good to think ahead and stay in front. That's what we try to do for you guys. What are your thoughts on these points? Share down below so we can all hash this thing out. Subscribe for free, and we'll see you guys next week.